Hello, everyone. This is Liz, one of the co-founders of the Real Estate InvestHER community. Welcome to today's webinar. I'm going to be getting Jay here in a moment, but I'm so excited to have everyone here. It's almost noon Eastern Standard Time. So in the chat box, always like to get connected to all of you. I would love to hear where you're calling in from, your name, what you're excited about learning today. So excited and honored to have Jay Scott with us here today. And it's a great topic in terms of analytics, and we're going to get into a lot of cool things around analysis. So please share in the chat box what you're excited about learning as we are have everyone joining us and get going here. So, and I'm going to get Jay here, and then we'll get rolling here on time. But thank you for everyone being here. Very excited. Okay. All right. Jay, you should be joining here. Hey, Rebecca from Orlando. Paige from Charlotte. Awesome. Hey, Paige, thanks for being here. Mary from Syracuse. Hey, Beverly from Philadelphia. That's my friend Beverly. Hey, Rita from Arizona. Also, I know Rita. Very cool. Hey, Jeannie, what's happening? Cool. More clarification on cap rate. Very important. Hey, Heather from Orange, California. Much warmer than it is where I am. Jay, can you speak? Are you having issues? I wonder if there's anything I can do.
I can speak, but it says that I'm not allowed to start my video.
Yeah, that is a issue. So let me see here. I'm going to make you a co-host too.
There we go.
Hey, Jay Scott.
How's it going?
How are you?
I'm doing well. How are you doing, Liz?
I love your background. You got all your books there. I love it.
Thank you. I have my wife to thank for that. She designed it for me.
I love it. Are they just like little posters?
They are, what do you call those? Not vinyl, but whatever the material is that
Cool.
that's smooth.
Love it.
Yeah, they're really cool.
I love it. Well, thank you so much for being here today. It's good to see you.
Absolutely. Thrilled to be here.
Yeah, I appreciate it. I was excited to hear. Did you call? Awesome. Nice. Thanks for being here, Bernice. I'm just looking at reading comments too. Washington. Very cool. Hey, Menza. That a pretty name from Virginia. Very cool. Nice to have everyone on. We'll get rolling here. It is noon. And Jay, thanks so much for being here. We have, how long have I known you, Jay? Quite some time. We go back.
It's been a long time.
It's been a long time. You know, Jay was definitely one of our first connections we made as my husband and I got more involved in Bigger Pockets, which was 2013, many moons ago. And Jay is one of the most knowledgeable people I know in this business. And he just has such a service-oriented way about him too. So not only super smart, super knowledgeable in so many different assets classes, so to speak, but just very giving and service-oriented. So Jay, thank you for being here. Really appreciate it. And thank you for everyone joining us. We had a lot of people registered. We have almost 100 people on here with all of us. So I'm going to get started. We have a lot probably in store. I know Jay very well. And if I know anything, he's got a lot prepared for you, and especially in terms of our topic here today, right? So let me do this, and I'm going to start rolling here because we'd like to, if you're new to our community, please put in the chat box that you're new. I always love to get connected to everyone that could be new, or this is literally your first event with our community, whether you maybe heard about us from our podcast or a meetup or however you found us. So I love to hear that you're new. So really appreciate you being here. So Jay, I'm going to give you the floor in a minute because you want to be hearing from Jay around this topic of evaluating deals. So I'm just going to give you a quick overview of our community very quickly, and then jump into today's topic. All right. So our mission, just to share a little bit about our mission at InvestHER, our mission is to empower women in real estate to live a financially free and balanced life on their own terms. That's also a very important part. We're all about creating an intimate global platform where women can really create deeper connections with one another. And we're doing that through a lot of different venues. And I'll share what we're up to in a moment, but we're really all about creating this intimate global platform where women can give and get what they need when they need it. So first off, we have a podcast for those who don't know. It's published by the Bigger Pockets Network. And we have episodes twice a week, Tuesdays and Fridays. So definitely tune in. We're always interviewing phenomenal women. And we just celebrated our 5th anniversary. So we have over 330 episodes. So a lot of different episodes, a lot of different women connecting to their, specialty. So check that out. We do have meetups across the country. We have almost 3, I think, in Canada. And the point of that is for local community of women to come together. Our meetup leaders are phenomenal, and we're looking to grow as well. But that's a safe space for women to give and get what they need. I had a person the other day say, why is your community needed? Like, just like that. I was like, oh, nice to meet you too. But I was thinking about it, and there's a lot of reasons, right? As someone who's the co-founder of our community, but I said, one of the biggest things that we are cultivating, whatever we're up to, is creating a really non-intimidating environment for women to really ask the questions they need, get what they need, and give what they need to one another. So it's all about creating that non-intimidating environment. We also have a Strive membership that's growing. We are also going to be, this is really for experienced women, 5 to 10 deals, but it's a high-level mastermind coaching, really neat program we've put together for about 2 years. But it's all about creating support for women who don't want to be solopreneurs, growing their portfolio, and you can apply at any time on our website. Facebook community, you know about this, but you can be posting questions, getting the support you need. There's women coming in every week. We hold that very closely to our hearts, so we do not like self-promoting. We're very, very mindful of that. So just want women to really support each other. We are always doing events. Excited to have the event today with Jay. We do events in person, online. We also have an EXP team as well. That's for real estate agents who are women who are looking to also grow their portfolios. And we're also active investors. Andres and I are active investors. Our pod mentors are active investors. It's one thing to lead masterminds and coaching, but you also need to be involved in real estate investing. And I've been an investor for 20 years. And I'm always learning and growing and evolving. So lastly, we have our conference. If you've not heard about this, please join us. We're excited. May 18th and 19th in sunny Scottsdale. We are going to be creating, this is a real transformational conference we're so excited about. This is our second one. And yeah, I think our pricing is going up March 1st. So if you have not gotten your ticket, come join us, play in the arena. We have 20 speakers. Sharon Lecter is one of our keynotes. We have women coming from investing, generational wealth, topics of finances, how to teach your kids finances, and obviously self-care and taking care of yourself along the way. So come join us. It'd be amazing to see you and meet you. And then lastly, I just want to give a big shout out to our sponsors. These are phenomenal companies that have been kind of on the front of the front of the room, if you will, to really say, how can I support you all in terms of your mission, supporting women investors in our space. So these have been great companies. We have companies doing all different types of things, but I definitely encourage you to check them out. And they're going to be there at our conference. So without further ado here, I'm going to stop sharing. Jay, thank you so much for being here. I'm going to throw the floor to you. I know you probably have a lot in store. Just a couple housekeeping. I'm not leaving, obviously, just going to go out and take a walk or anything. I'm just going to turn my voice off and my screen real quick. And just from a housekeeping perspective, if I can encourage everyone to please put questions, you're going to have questions for Jay. Knowing what he's going to be sharing and knowing how knowledgeable Jay is, you're going to have questions for him. So the way that I'm going to approach question asking is that I'll let Jay, you can go for, your presentation, and obviously we'll end about 10 minutes prior or at least 15 minutes prior to the hour and field some questions. Please put them in the Q&A box. That's why we have a Q&A box. Don't put them in the chat box because the chat moves so fast that I can't keep up with that. So please put them in the Q&A box. And then I'll come on about 20 of or so if that works for your timing, Jay. And we'll ask some, field some questions.
All righty.
Does that sound good?
That sounds good.
All right, awesome.
I'm already 7 minutes down, so I'm going to be speaking very quickly. And so anybody that hasn't heard me speak before, I have a couple of rules when I speak, rules for myself, not rules for you. You just listen, enjoy, hopefully get stuff out of it. But the rules I have for myself are: one, I am not a professional speaker, first of all. I'm a professional real estate investor, and I speak because for some reason people like to hear me speak, but I try never to give the same presentation twice, which is good because that means if you've heard me speak before, you have not seen this presentation. It's bad because it means I probably haven't gotten this presentation polished. Like I literally wrote it over the weekend, and this will be the first time giving it. So apologies if it's not perfect or polished. Number two, I don't do fluff. I'm a numbers guy. I'm an engineer by education. I'm an engineer by mindset. So I'm going to be digging into some numbers and technical stuff. I would encourage you, if I go over anything that you don't understand, ask questions at the end, shoot me questions via email, or rewatch the presentation, because there'll probably be some stuff that I probably go by a little bit quickly. So with all that said, let's jump in. Our topic today is key metrics in evaluating deals. There are so many different types of deals. There are so many different metrics that if I tried to cover that topic in completeness, no way I could do it. So for today, I'm going to be focused on rental properties. And I'm going to be talking about the key metrics in rental properties, and specifically how your rental properties generate returns. And keep in mind, a lot of the stuff I'm talking about today will apply to other things besides rental properties. It'll apply to flips. It'll apply to multifamily. It'll apply to syndication. It'll apply to other commercial. It'll apply to even things outside of real estate. But I'm going to use the example of a single family rental property today, and that will be our hypothetical, our example. A little bit about me. I'm not going to spend a lot of time here, but I'm a partner at Bar Down Investments. My partner is Ashley Wilson. Some of you may know her. She's been integrally related to InvestHER for a number of years now. So you may know her through InvestHER or other ways. But Ashley is my business partner. I've written 5 books for bigger pockets. The most recent is a book called Real Estate by the Numbers, which basically digs in a whole lot more detail to the topic I'm going to be talking about today. I currently own just under 1,000 single and multifamily units across the east and the southeast of the US. And I've done about 150 million in transactions since 2008. Okay, let's jump into our topic. 4 ways. There are 4 ways that rental properties, investment real estate, generate returns. And we can get nuanced and say there are probably 50 different ways. But at the end of the day, if we kind of bundle them up, there are really only 4 ways that real estate generates returns for us. Number 1 is through this thing called cash flow. So every month we have our properties hopefully rented out. Our tenants are paying us money. We're taking some of that money and we're paying for operations, things like taxes, insurance, maintenance, those types of costs. Hopefully at the end of every month, we have some money left over that goes into our pocket as profit. We call that cash flow. So that's the first way that rental properties generate returns. The second way that rental properties generate returns are through this thing called amortization. That's a fancy way of saying that if you get a loan on your property, every month you're making a mortgage payment. Hopefully your tenants are paying their mortgage, or they're paying their rent. You're taking that rent and you're using some of that to pay the mortgage. Well, part of that mortgage payment is principal. Part of that mortgage payment gets paid down. Your principal gets paid down every month. So at the end of every month, hopefully you owe less on your mortgage than you did the month before. And so that's a way that we can capture equity. We can capture returns from our real estate through paying down that mortgage every month. And we'll talk more about that in a few moments. So the third way we make returns in real estate is through this thing called appreciation. The value of our properties go up, and they go up by 2 methods, one called natural appreciation, one called forced appreciation or forced improvements. And you might be surprised exactly what the numbers look like when it comes to appreciation for rental properties, but we'll dig into that as well in a few minutes. But the third way that your rental properties are going to generate returns for you is through these 2 forms of appreciation, natural and forced appreciation. And then finally, and this one's overlooked way too often, and I could do an entire hour or 2 or 5 on this topic, but tax benefits. So real estate is probably the single best way, the single best investment for generating tax benefits from your investments. So a lot of times we don't realize this until we get a little bit older. For me, I was 40 something before I started to recognize the benefit of real estate and using it to be able to defer and eliminate my tax burden. But real estate is a great way to to use tax benefits to your advantage to save money and to earn money. And we'll talk about that as well. At the end of the day, though, these are the 4 ways that rental properties generate returns. And through this presentation, I'm going to be digging in a little bit more to each of these with respect to the metrics and the returns and how we calculate them. So for today's hypothetical example, we're going to be talking about this property. I know this looks just like a bunch of numbers right here, but at the end of the day, this is an example deal. This is a deal. And I will provide, if Liz will make it available, I'll be happy to provide everybody this spreadsheet. This is the spreadsheet that I use and have used for over a decade to analyze my deals. If you have gone on Bigger Pockets and you've looked for a rental property calculator, besides the main one they have on the site, which was based on this spreadsheet, I uploaded this spreadsheet back in 2012. It's been downloaded 60 or 70,000 times off of Bigger Pockets, but I'll provide it as well. But basically, this goes through all the metrics that we need to put together the analysis of a rental property. And this is a particular deal that we'll be talking about today, and I'll dig into this as we go through. But at the high level, here are the things we need to know about this hypothetical deal. We're purchasing this deal, let's say, for $133,000. I know this property, this was actually a real property we purchased a year or two ago. I know these numbers look a little bit low. That's because things were a lot different a year or two ago, as we probably all know. But the purchase price on this property was $133,000. According to the county tax assessor, about 25% of the value of the property was attributed to land, about 75% was attributed to the building or the structure. I put in about $15,000 in improvements, renovations, and I spent about $4,655 on closing costs when I purchased the property. I'm not keeping any reserves. I don't need reserves for this property. And then on the financing side, I did get a loan. I got a 75% loan to value loan. So I put down 25% in down payment. I financed total $114,491. So I had to come up with $38,164. So 25% of the total all-in cost. My interest rate, again, this was a year or two ago. My interest rate was 4.125% with a 25-year term. So that basically means that the loan would be paid down over 25 years. And after 25 years, it would be fully paid off. My monthly mortgage payment would be $612.26. And again, I had to come out of pocket $38,164. So my bank account was $38,164 less the day I bought this property than it was the day before. Okay, so this was the deal that we're going to be looking at today. So let's talk about the 4 ways that rental properties generate returns. And let's use this hypothetical, or not so hypothetical, because this was an actual real deal that I did. Let's use that deal to dig into some of the metrics that I looked at before purchasing this deal to try and determine if this was a deal that I was going to be interested in actually purchasing. So let's start with cash flow. And I talked before about the fact that cash flow is basically that money that you generate every month, hopefully month after month, from the income you're generating minus the expenses that you're spending. We look at 2 particular metrics, or we want to look at 2 particular metrics when we're talking about cash flow. There are a whole lot more, but these are the big ones: cash flow and cash on cash return. So let's jump into what those mean. So here's our hypothetical example. This is just a piece of that spreadsheet that I showed you earlier. And what you'll see is in yellow, that yellow highlight, that bar running vertically towards the left that says year 1. This is what our year 1 income and expenses look like. So this property was going to rent for $1,575 a month. That was my pro forma rental. That's what I expected I could get in rent every month. So in year 1, I expected to generate about $18,900 in rent, best case. That was assuming I got full market rent every month for 12 months in year 1. Realistically, we don't always get 12 months worth of rent. We have some vacancy or loss rate. A lot of reasons we can lose money. Maybe a tenant doesn't pay. Maybe the unit's empty. Maybe it's rented under market. Maybe we give concessions. But for a typical rental property, the biggest reason we lose rent is simply because the unit is vacant. And so I like to assume typically in the market that this property was in, that this property, our rental properties will be vacant about 6% of the time. So I assume that 6% of that $18,900 would go away, and my gross income would be about $17,766. So that's how much income I expected to make in year one. Then I had to pay all my expenses. And so here are my expenses, things like property taxes, insurance, maintenance. I'd have some utilities for when the property was vacant because I had to do renovations or whatever it was, and I was paying utilities during that time. Turnover costs, so I might have to replace the carpet or repaint between tenants. This property had a pool, and so I had to do some pool maintenance every month just to keep it clean and functioning. I had a property manager who charged 10% of the gross income for their services. And then I had capital costs. So those big ticket items that you might only do every 20 years, but you really should budget for on a monthly basis because they add up. And I'm not going to talk about that here, but I like to budget about $100 to $150 a month for all my capital costs that I'm going to have to put in over 10 or 20 or 30 years. So my total expenses here were $8,284 expected in year one. And so if you subtract the expenses from the income, I expected my net operating income, and I'm not going to talk a lot about what that number means. When you get into commercial and bigger deals, this is a super, super important number. But for here, just know that net operating income basically means your total income minus your general expenses, $9,482 at the end of year one. The one big thing that net operating income doesn't include is my mortgage. So my mortgage, $612 every month, so $7,347 at the end of year one. We'd spend about $7,300 in mortgage in year one. So my cash flow, the amount of money that would end up in my bank account before taxes at the end of year one would be $2,135. And you'll notice that in years 2, 3, 4, 5, that number goes up a little bit simply because our income is going up a little bit higher than expenses. I model 2% increase in rents, 2% increase in expenses. So every year that cash flow should go up by a little bit because my rent is going up a little bit faster than expenses, or they're going up at the same rate, but my rent's higher than my expenses. So it goes up faster than the expenses in real numbers. So end of the first year, $2,135 into my bank account that wasn't there the year before. That is my profit before taxes, or what we call cash flow before taxes at the end of year one. Now, is $2,135 a good amount? Well, it depends. If I put in $50 to get that $2,135, that's great. Put in $50, get out $2,000 a year, that's amazing. What if I put in $1 million? If I put in $1 million, getting out $2,000 a year really doesn't seem that attractive. Basically, it wasn't worth that $1 million investment. So we have this metric called cash on cash return, which is basically telling us how hard each dollar we invested in the deal is working to generate returns for us. And so to get cash on cash return, what we do is we divide our annual cash flow, the amount of money we're making every year, divided by the amount that we invested into the property. And if we go back to our spreadsheet, we just talked about the fact that we generated $2,135 in year one. We invested originally $38,164 into the deal. So our cash on cash return in year one was 5.6%. I like to compare this to any other investment that's generating cash every year. So for example, compare this to treasury bonds. Treasury bonds these days are generating 4 or 5%. This is a decent return compared to treasury bonds. Obviously, this is a lot more work than just buying treasury bonds, but that's a good comparison. Maybe dividend paying stocks. What do dividend paying stocks pay? 3%, 4%, maybe 5%. So this is doing a little bit better than dividend paying stocks. But again, this is a lot more work than dividend paying stocks. If this was the only return we were making from our real estate, we'd probably want to take that money and we'd probably want to put it into bonds or dividend paying stocks or something else, maybe even a high yield savings account that's paying almost this amount, 4 or 5%, because there's risk in real estate and there's a lot of work and effort that goes in. But luckily, this 5.6% isn't the only money that we're making from this rental property. It's one of 4 ways that we're making money from this property, but not the only one. So from a cash flow perspective, again, that operational income that we're making month after month, year after year that goes into our bank account before taxes. $2,135 in year one, 5.6% cash on cash return. But like I said, that's only one of four ways. Let's talk about the next big way that we make money on our rental real estate, and that's amortization. And again, that's just a fancy word for every month our tenants are paying down our mortgage. They're paying down interest on our mortgage and also principal on our mortgage. And so that is a return for us, and we'll talk about why in just a second. But the two big metrics that we look at when we look at amortization are this thing called equity on cash return and total return. So let's see what that means. Number one, we have this thing called amortization. Amortization just means that, again, every month, part of our mortgage payment, the principal part of our mortgage payment, is being paid down. And that's because our loan payment every month consists of two pieces. It consists of the interest that we're paying on the loan, and then it consists of some amount of principal that's being paid down every month. So we knew that our mortgage payment on this property was $612. That came from our calculator above. And so some portion of that $612 every month is interest on the loan, and some portion is the principal that's getting paid down, meaning if we paid off that loan tomorrow, it would cost less to pay off that loan than the original loan amount. How much is principal? How much is interest? Well, we can stick those numbers into what's called an amortization calculator or schedule. And what we see is in month one, we're paying that $612.26. $218 of that is principal pay down. So after month one, while we took out a $114,491 loan, after month one, if we were to pay off that loan, we'd only have to pay off $114,272. Basically, we paid down $200, a little over $200 in principal. That is equity we're building in the property. That's money that we are accruing in the property every month when the tenant is paying our mortgage. How much do we make after a year? Well, after the first year, we made $2,675 in principal pay down. This is equity in the property. It's not cash that went into our pocket because we don't really get that money until one of two things happens. We get that money when we refinance the property and we basically pay off this loan. We're paying off this loan for less money than the original loan amount. Or we sell the property. If we sell the property, we pay off the loan. And again, we're paying off the loan with less than the original amount. So we took out a loan for $114,491. But if we paid it off at the end of year one, we only have to give the bank $111,817. That $2,675 is money that goes into our pocket again when we refinance or when we sell. And every year we're paying off more and more of that loan. And in fact, every year, the amount we pay off, the principal that we pay off, goes up because the loan balance goes down. So each payment accounts for less interest and more principal. So after 10 years, we've paid off $32,000 on this loan. And if we were to sell this property after 10 years, we would only owe $82,000 to the bank, even though our original mortgage was $114,491. So that is the benefit of amortization. That's the benefit that we get from our tenants paying our mortgage every month, is that we are accruing this equity. Now, again, that's not cash in our pocket until we sell the property. But at the point that we sell the property or we do a refinance, it's as good as cash. And so instead of calling that a cash on cash return, I like to call that equity on cash return, meaning we're building equity on the property every month. We're not necessarily getting cash going into our bank account. It's as good as cash when we sell or refinance, but it's not as good as cash on a monthly or annual basis, because we don't actually get it into our bank account. But we still factor it again because it is as good as cash eventually when we sell or we refinance. So what is the formula for our equity on cash return? Well, if we take our annual equity accrued, basically the amount of principal that we're paying down on our loan each year, and we divide that by our initial investment, and there's our amount we're paying down in year one, there's our initial investment, we see that our equity on cash return is about 7%. Again, not getting the cash every month or every year like we do with our cash flow, but the day we refinance or the day we sell, we're capturing that 7% return in year one and whatever it is in years 2, 3, 4, and 5, whenever we decide to sell. So if we're going to compare, the return on real estate to something like the stock market, let's say, my take is that this thing called a total return is the best way to compare the returns we're going to generate from real estate to something like the stock market. And total return is basically adding up two things. It's adding up the cash flow that we're generating, basically the money that's going into our pocket every month, plus the equity that we're accruing, the principal that we're paying down every month. And we take those two things, which are both as good as cash. Again, cash flow is as good as cash the day we get it. The principal pay down or the equity accrued is as good as cash the day we sell or refinance. Take those two things that are as good as cash, divide it by the initial investment, and that tells us what our total return on this property is. So in this case, our annual cash flow we've determined was $2,135. Our equity accrued in year one was $2,675. We add those up, divide that by our original investment of $38,164. And what we see is our return in year one is now 12.6%. If we were to sell this property after year one, we would have achieved, once we paid off that loan and captured that equity, we would have achieved a 12.6% return. This is the metric when I look at comparing real estate to, again, the stock market or any other traditional asset. This is the number that I like to use, this total return number. And as you can see, 12.6% is pretty good. It's more work than the stock market. If I were going to invest in the stock market, I might make 7, 8, 9% long-term with no work. So 12.6% with the work that goes in. I have a property manager, so it's not a ton of work, but that basically tells me what I'm going to get compared to something like a stock market investment. So if you add up the cash flow and the amortization, you get this total return, about 12.6%. Again, this is what I like to use to compare to other traditional investments. But at the end of the day, real estate gives me two more types of return on top of those two things. So the 12.6%, again, it's the number I would use to compare to the stock market. But in the back of my mind, I know that I'm getting two additional benefits as well that actually make my returns better than that 12.6%. And so let's talk about those. First, let's talk about this thing called appreciation. And I mentioned that there are two types of appreciation. There's natural appreciation and there's forced appreciation. Natural appreciation is simply how much real estate tends to go up over time. The fact that our real estate is worth X today and in 10 years from now is going to be worth Y. So that difference between X and Y, that's how much I'm getting from natural appreciation of my real estate. Then there's this thing called forced appreciation. Forced appreciation is the amount I get the real estate to go up in value based on the renovations or the improvements that I do. This is the money, the time, the effort that I put in doing renovations, doing better management, doing whatever it is, that I can take the value of that property from X to Y by not necessarily putting in Y minus X dollars, if that makes sense. And we'll talk about that in just a second. But these are the two ways that we can force, or these are the two ways that real estate goes up in value over time. So let's look at these. Number one is natural appreciation. A lot of people like to assume that real estate goes up a good bit per year, 5, 6, 7, 8, 9, 10%. In reality, if we look at the data, on the left, we basically see the data from 1900 to about 1982, 1983. If we look at the data for that first 83 years starting in 1900, what we see is that real estate essentially stays flat in value compared to inflation. So adjusted for inflation, the price of real estate between 1900 and 1983 really didn't go up. It went down compared to inflation between 1915 and 1945. It was a little bit higher than inflation between 1945 and 1982, but that red line is basically adjusted for inflation. And what we saw was for 83 years, real estate stayed pretty much completely flat compared to inflation. Real estate went up at the same rate as inflation. Now, between 1983 and 2014, and we could go a little bit further, but let's stick with 2014 for here. We had this better index called the Case-Shiller index, which is basically the same thing as that graph on the left, but they use some better data. And so what we saw between 1983 and basically 2002 was that, again, real estate stayed pretty flat relative to inflation, didn't go up, didn't go down. And then between 2002 and 2007, real estate took off. The value of real estate just soared, and compared to inflation, it much outpaced inflation. But then 2008 hit, we saw a big decline in values. And if you took that long-term adjusted value of real estate back in 2009, 2010, 11, 12, we were right back at that trend line. Long story short, between 1900 and 2014-ish, real estate has appreciated right about the rate of inflation. Now, since 2014, real estate's gone through the roof again. We see a spike that's even bigger than that spike we see between 2002 and 2007. But if I had to guess, and this is a whole separate discussion, if I had to guess, I would say that we're going to see real estate come crashing down, but not necessarily values come crashing down. The inflation adjusted values come crashing down over the next couple of years. So I think what we're going to see long term is that same trend that we saw from 1900 to 2014, which is real estate tends to increase naturally at the rate of inflation. What's inflation been since 1900? About 2.95%. So if you want to include the value of your real estate going up naturally, just prices appreciating, I would say over a long period of time, assume your real estate's going to go up about 3% per year on a compounded basis, because that's what it's done for most of the last 120 some years. Okay. Not saying this is going to hold true in every area. Some areas, real estate's dropped in value over the last 50 years. In some places, it's gone through the roof and it's appreciated much more than 3%. But in general, 3% is probably a nice, safe number to use for your real estate appreciating over the long term. Then we have forced appreciation. Forced appreciation is basically you put a bunch of money into the property to do renovations or management improvements. After you put that money in, you have some new value for the property. We call that the after repair value. If you subtract from that new value, whatever you purchased the property for and whatever you put in terms of rehab, that's the delta. That's the extra money that you've created in value. If you buy a property for $100,000, you put in $50,000, it's now worth $200,000. Well, you put in $150,000 total and it's now worth $200,000. You've forced depreciation of $50,000 on this property. Now, our property is actually not that interesting. We put in $15,000, and I'm guessing that after I did the repairs, that the after repair value is about $150,000. We put in $15,000 on a $133,000 purchase, so we were all in between purchase and repairs of $148,000. After we did that, I estimate that this property was worth about $150,000. So if we do the math, what we find is that what we created in this case was only about $2,000 in forced depreciation. Not much. A lot of times we do big rehabs and we can create a lot of value through these renovations. But again, this particular property is a real life case, a real life example. And in this case, we really only made about $2,000, but it's $2,000 that we didn't have before we bought this property. So our forced depreciation on this was $2,000. So going back to our chart here, the third way that rental property generates returns is through appreciation, natural appreciation, and forced appreciation. Natural appreciation, despite what people might think, despite what people might tell you, is typically right around the rate of inflation, 3% per year on average. And our forced appreciation on this particular property was only about $2,000, though obviously on some properties it can be much, much more. If we don't do any renovations, that number is going to be zero. But that's the third way that rental properties generate returns. The fourth way that rental properties generate returns, and I'm going to do this one pretty quickly. Again, I could spend hours talking about tax benefits. I would highly recommend that especially if you're a full-time real estate investor or you're thinking about becoming a full-time real estate investor, dig into this topic a lot more, because there's a lot of benefits here that aren't discussed nearly enough. I don't have the time to dig in, but let's talk about tax benefits a little bit. Tax benefits being the fourth way that rental properties generate returns. There are two big metrics that I like to look at when I look at tax benefits on a rental property. Number one is this thing called depreciation. And then we use that depreciation number to generate what I like to refer to as the total tax benefit on the property. So what is depreciation? Depreciation is this phantom. We call it phantom because it's only on paper. It's not a real loss, but it's this loss that the government allows us to take every year on our investment real estate. Basically, the government says, we have this structure, we have this house, we have this, whatever it is. It could be a self-storage facility, a multifamily, it could be a warehouse, whatever it is. Every year, this thing is deteriorating. And every year we have to spend money to keep up the value of this property. And so the government allows us to say, every year we're going to take the value of this structure and deduct part of its value for that deterioration. For residential real estate, the government says we can basically deduct the entire value of the property over 27 and a half years. 127 and a half per year for 27 and a half years. And so we can use that as a write-off against our passive income, against our rental income. And if you're a certain type of real estate investor, you may be able to use that write-off against all of your income, but we can use that depreciation as a write-off against our income every year, lower the amount of income that the government or the IRS sees that we have, and save money because we've lowered our working income, our adjusted gross income. So in this case, our depreciation is building value divided by 27 and a half. The building value here, we estimated about $99,750. If we divide that by 27 and a half, we basically get $3,627 per year for 27 and a half years that the government is going to allow us to deduct from our rental income. So every year we can take whatever money we made from this property or other rental properties, and we can deduct $3,627. And now we only have to pay taxes on that lower amount. We basically save taxes on $3,627. That's our depreciation. Now, what does that mean to save money on $3,627? Well, we all have this thing called a marginal tax bracket. This is the tax bracket that we're in. This is the amount of tax that we pay on every dollar that we make at that maximum amount that we earn. And so, for example, a lot of us are at the 24% tax bracket level, which means for every dollar we earn, we're paying about 24% in tax. So I'm going to use that as an example here for the total tax benefit. The annual tax benefit, the benefit that we get every year, is our depreciation amount times whatever we would have paid in taxes for that particular month, or for that particular year. So in this case, our depreciation was $3,627. We saw that in the last slide. And normally we'd be paying 24% on each dollar of that $3,627. But because we got to write it off, because we got to pretend that we didn't make that income, as far as the IRS was concerned, we saved 24% of that $3,627, or a total of $871 in year one. And then we're going to do that in every year afterwards. We get to write off $3,627, and we save $871 per year. That's real tax saving. That's $871 that we would have given the government that we can now reinvest into something else. So let's say we're going to hold this property for 10 years. And let's say year one, we're going to take that $871 that we saved, and we're going to invest it in something that's going to generate us 10% return. And we're going to do that in year two with the $871 that we made, in year three, in year four, in year five. That $871 each year for 10 years, growing at 10% compounded, is going to turn into $17,528 at the end of 10 years. Basically, our tax savings of $871 is going to total $17,500 after 10 years. That's how much money that we've earned from this tax savings. Or is it? Not really, because at the end of 10 years, if we decide to sell this property, the government says, we're going to give you this tax benefit, this depreciation benefit, but when you sell the property, you basically have to pay us back. So the amount that we would have to pay the government back is that $3,627 for 10 years. And they tell us we have to pay it back at 25%. It might be 24% in some cases because that's what you paid. It might be less in some cases, but we like to assume that we're going to have to pay that back at 25%. So at the end of 10 years, we're going to have to give the government back about $9,000. But that money was working for us for 10 years. We were compounding it. We were investing it. And so we earned $17,500. We only have to give the government $9,000. So at the end of 10 years, we still have $8,461 that we wouldn't have had if we were paying that extra tax every year. So the total tax benefit on this particular example over 10 years is $8,461. We're going to have $8,461 in our bank account at the end of 10 years that we wouldn't have had if we were paying that $871 in extra tax every single year. So that's our tax benefits. Depreciation, again, $3,627, which translates in this case to about $8,461 in real income, in real profit at the end of 10 years. These are the four ways that rental properties generate returns. And again, if we were to enumerate this compared to other investments, I would say that we would compare that 12.6% to what we would get in the stock market. In addition to that, we're also getting some natural appreciation. Sometimes we don't like to think about this. We say, hey, if the property goes up in value, great, but I'm not going to factor that in, but we can. We're also going to get some forced appreciation. So if we did renovations to the property, we might generate some value there. And if we take advantage of those tax benefits, which we absolutely should, there's cash in our pocket there. So let's put all this together. Let's say we have this property. We know what we're getting on an annual basis. We know how to compare this to the stock market on an annual basis. We know what the appreciation might look like. We know what our tax benefits look like. But let's say we're going to hold this property for 10 years. What is the actual total return after 10 years between all four of these different pieces? What is the total return that we're going to achieve from this particular property? Well, we can use this metric called IRR, or internal rate of return, which will measure the compounded rate of return for the investment over the entire period that we hold it, from the day we buy it to the day we sell it. And what we need to do to generate that, or what we need to know to generate that, is we need to know for every period of the investment. For this case, we'll do it on an annual basis. We could do monthly, but on an annual basis, how much money are we putting into the deal, or how much money are we taking out of the deal? How much money is coming to us in profit? And if we plug these numbers into a spreadsheet, we can determine what the total return on this investment is over the entire hold period. So let's take a look at how this might work. So in this case, let's say we bought this property in January of 2022. I don't know why I picked 2022. I think I forgot that we're in 2023. That's what happens when you get old. But let's say we bought this property in January of 2022, and that money that we put in January 2022 is our initial investment. That's money that's going out. So that's a negative. That's money that's leaving our bank account. How much do we have to spend to buy this property? If you remember back to earlier, we spent $38,164. So basically in January of 2022, we put $38,164 into this investment. It's negative again because it came out of our account. It's money that we had to spend for this investment. But then every year for the next 10 years, remember, we're generating cash flow. We're generating money that goes right into our bank account before taxes every year for the next 10 years. And if you recall from our spreadsheet, it looks something like this. In year one, we generated $2,135 and then a little bit more each year for 10 years. So we can basically say for the next 10 years, each year we're generating that amount of money in cash flow. So that goes into our spreadsheet. Lastly, in year 10, in January of 2032, we're selling this property. And we're going to get money back from the sale of this property that, again, is going to go into our bank account. So how much money are we going to get back from the sale of this property? Well, we're going to get whatever we sell the property for, minus whatever we have to use to pay off the loan, because we still have to pay the bank off, whatever we owe them, minus some set of sales costs. So it's going to cost us something. We might have commissions, we might have closing costs, et cetera. But if we do that calculation, we can determine exactly how much money the title company is going to hand us when we sell this property. So let's figure this out real quick. Our sales price is our after repair value. So it's the amount of money this property was worth after we did the renovations, plus the natural appreciation that we saw for the time period that we held it. So in this case, if you remember that slide earlier, we estimated that this property was worth $150,000 after we did that $15,000 worth of renovations. So at the beginning of this project, we have a property that's worth $150,000. Remember, we talked about natural appreciation being about 3% per year. Well, if we start with a $150,000 investment and we grow it 3% per year for 10 years, what we find is that in 10 years, that property should be worth about $201,587. Again, just rough numbers. We don't know. It could be 250,000. It could be still 150,000. But if you look at historic averages, 3% a year is probably a good assumption for growth of the property through natural appreciation. So future value of this property when we sell it in 10 years, we're going to assume it's somewhere around $201,500. That's our sales price 10 years from now. We also have to pay off our loan. How much is it going to cost to pay off our loan? Well, we have our original loan amount, but then we have that principal that we're paying down every month for 10 years that we no longer have to pay the bank because that's equity that we've accrued in the property. So we go back to our spreadsheet. We see that we started with that $114,491. Over 10 years, we've accrued $32,416 in equity. So in 10 years, the bank's going to say, you still owe us $82,076. So to pay off this loan 10 years from now, we have to give the bank $82,076. We've earned $32,000 in equity in that time. So going back to this, the spreadsheet here, our sale proceeds is going to be our sales price minus the loan payoffs minus the sale costs. Our sales price was $201,000. Our loan payoff was $82,000. I'm going to assume about 6.5% in sales costs, whatever numbers you think are right for you in your area, but I'm going to say 5.5% commission plus another 1% in closing costs, so about $13,000. So when I sell this property in 10 years, the title company is going to hand me a $106,511 check. That's money that's going to go into my bank account. So I want to add it to this January 2032 amount that's flowing into my bank account. So in January 2032, between the sales proceeds and my cash flow that year, I'm making $110,496. I plug this into Excel and I use this fancy formula called XIRR, which is just a way of calculating the internal rate of return. And it tells me that over the 10 years that I held this property, I've earned 15.8%. Now, this doesn't factor in the tax benefits. I probably could have put that extra $8,400 there. I like to be conservative and I don't like to include tax benefits. I just kind of consider that to be a nice to have. But if I really wanted to get into the nitty gritty, I could have added another $8,000 that I earned in tax benefits in that January 2032 number. That internal rate of return would have been a little bit higher. But basically over 10 years, I'm generating about a 16% compounded return on this investment. Go and compare that to other options that you have for your money. What do the compounded returns look like? Investing into a syndication or investing into the stock market or investing into crypto or investing into bonds or investing into whatever it is, and make that comparison to that 16% internal rate of return for this property. And that should give you an idea of whether this is a good thing to be investing in or whether you should be taking that money and investing in something else. Okay, so that is everything I have. I am happy to take questions at this point. Real quick, if you want to get in touch with me, if you have any questions or you want to learn more about me, if you want to potentially talk about investing with us, if you're doing multifamily and you want to talk about our multifamily mentorship and coaching program called Apartment Addicts, or if you just want to reach out to me with questions about anything, this is how you can reach me, J. Scott Investor, on pretty much all social media. Connect with jscott.com. We'll link you out to everything you need to know. Bar Down Investments is my multifamily company. Apartment Addicts is the coaching program, and jscott.com is my personal website. And that QR code will take you to one of those. I think connect with jscott.com.
Awesome. Ooh. Very cool. Whoa, Jay, you got to take a deep breath. That was great. I love it.
And 10 minutes left.
And 10 minutes left. Now we'll field some questions. Some of these were done earlier in the presentation. I think you'd spoken about early on about what is reserves for here. I'm not sure. We're gonna have to probably skip that one, but unless you.
Let me go quickly here. So the reserves is basically money that we would sometimes have to put aside if we thought that we were going to need money for something later, like a big repair or something. Anytime we put money aside, remember that calculation we did at the end where money goes in, money comes out. If you don't have that money to invest in something else because you're putting it aside, it's not earning you anything. So putting money aside is always going to lower your returns when you do that IRR calculation. So we put reserves in there just to know if we're putting money aside, that's going to lower our returns because we can't invest it somewhere else.
How about vacant? You can roll. Go for it.
Yeah. What percentage would I suggest using in today's market for vacancy or loss rate? This is going to depend on your market. So if I'm in a place, if I have a property in a market that's going to be highly desirable because it's just like this perfect rental, it appeals to the most buyers. It's just like your average median price rental in a good market that's performing well. I might use 6%. 6% is the lowest I'm ever going to use. I've seen lower vacancy rates, but I like to be conservative, so I'll never use less than 6%. But if I'm in a market or let's say I have a property that's a really high-end property that I think is going to be harder to rent, it's going to turn over more, or if I'm in a market where I think population's leaving, if I were in New York City and I was concerned that people were leaving, I might use 7, 8, 9%. If you really want to be smart about it, go talk to a local property management company that handles single family rentals and say, what's your average vacancy in this market these days? And whatever number they tell you, use that number.
Yeah.
How do you determine the maintenance budget? Whole separate discussion. I think 5% of the value of the property is a reasonable number to use, 5 to 10% depending on the condition of the property. But yeah, that's a whole separate discussion. Again, you can talk to a local property management company and ask them what numbers they're seeing for their tenants, but 5 to 10% is probably a good conservative number to use there. Again, if the property is in great condition, use closer to 5%. If the property is not in great condition, maybe closer to 10%. Do I still recommend 2% increase in rent and expenses in today's market? Again, that's going to really depend on the location. I tend not to care about anything other than year one numbers. Typically years 2, 3, 5, and 10 are going to be better than year one. So I like to assume that year one is going to be indicative of all future years. So in my head, I'm generally using 0% increase in both of those. We all know that it's not really 0%. In fact, expenses can be increasing faster than rents these days. So you might want to use actually 2% for rents or 1% for rents and 2 or 3 or 5% for expenses. Keep in mind, a lot of us are going to hold our properties long-term. Long-term, things are going to average out. We may see 5% inflation this year and expenses go up 5%, but long-term, I expect that number still to be in the 2 to 2.5% range. Long-term, I expect rents to be 2 to 2.5% range. So don't get caught up on what's going on in the market today. If you're planning to hold a property for 10 or 20 years, I think 2% is a good number for both because that's kind of the historic average. Let's see. Next one is about reserves again. Let's skip that one. Do I recommend using cash on cash returns to pay, to pay more down on principal? Whether you use your cash that you're generating to pay down the principal is really a personal decision. So a lot of us like to have less debt. And a lot of us are going to sleep better at night having less debt. Even if it's not a good financial decision, if having less debt means you're going to sleep better at night, then it's probably a good decision to have less debt and to use the cash flow to pay down your loans. Sleeping well at night, what I've learned is the most important thing, even if it means making a somewhat suboptimal financial decision. So that decision for whether you should use the cash that you're generating to pay down your loans or whether you should always be leveraged to the hilt. Again, personal decision, whatever your risk tolerance is. I tend to be pretty conservative. I like to have less debt than more debt. So I will often pay down my debt to at least 60% or highest 60% on my single family rentals, simply because I'm conservative, but do what's right for your risk tolerance. Do we take closing costs into account when calculating these ratios? I don't remember what I was talking about there, so I'm not going to take that one. How do you find the equity accrued number? So there's a formula that you can use in Excel called cumulative principal, CUMPRINCIPLE. cum prints. And it's in the spreadsheet that I'll provide. But basically, if you use that formula and the important numbers, which is the amount of the loan, the length of the amortization, the interest rate, you put all those numbers in, and it basically will spit out how much in principal you're paying down every month or every year. And so it's in the spreadsheet. It works automatically. And you can also go and do a search for amortization schedule on Google, and that will link you to a calculator where you enter the loan amount and the interest rate and the length of the loan, and it'll print out how much equity you're accruing every month. So you can do either of those. Do properties ever go down in value? Absolutely. Now, when do properties go down in value? Well, properties sometimes go down in value over short periods of time. So if you're planning to buy a property today and sell it in a year or two or three, consider that in any short period of time, properties can go down in value. We saw that in 2008. We've actually seen that over the last couple months in a lot of locations, properties going down in value. Typically, though, over 10 or 15 or 20 years, properties pretty much always go up in value. So I would say as long as you're modeling at least 10 years, don't worry about your property going down in value. If you want to be conservative, just assume that in 10 years, it's going to be worth whatever it is today. And if it goes up in value, if you get that 3% natural appreciation, or it's like the last couple of years where you get a whole lot more than 3%, well, consider that gravy. But again, whatever your risk tolerance is there. But yeah, short-term properties absolutely sometimes go down in value. Long-term, they tend to go up.
Why don't we do the last one, Jay? So I want to be mindful of your time. You've been so gracious. Beverly's asking about the property manager. We'll make that our last one for today.
Okay. Property manager, what do I look for? I want them to have a lot of units. I want them to basically, I find property managers the way I find all my contractors. I go to other investors in the market that I know who are successful, and I say, who do you use? Who are your contractors? Who are your vendors? Who's your property manager? Because the people that are in the market that are successful, they've been successful in large part because they picked the right property manager. So I'm going to go by references more than any questions I'm ever going to ask the property manager. In fact, if I talk to 2 or 3 or 4 people who I respect in the market and they all use the same property manager, I may not even talk to the property manager. I may just call them and say, hey, I want to hire you. Because again, referrals are better than anything the property manager is going to tell me specifically.
Yeah. Yeah. And I would just jump in too, because we've hired a number of property management companies and they're not all created equal. So you really want to make sure the property manager has an expertise in the particular asset type and the size of that asset type. So even multifamily property management companies are not created equal. If they're managing a bunch of duplexes versus 100 unit, totally different, strategy, totally different way of approaching those. So something we learned the hard way, but size and type matter, and their expertise in those 2 particular areas. And of course, market, they need to have an expertise in the actual market that they're looking to manage. But
can I answer one more question?
Yeah, go for it. Yeah, absolutely. Bonus one.
Yep. Somebody wrote, this is all great. However, I thought this webinar was about evaluating a prospective property and quickly figuring out if it made sense. I'm not going to address the quickly part because it's up to you how quickly you can do this. But in terms of what I presented here, hopefully the information you've gleaned here will help you determine whether this property makes sense for you. And the only way that works is if before you started evaluating this deal or any deal, you sat down and you said, this is what I'm looking for from a deal. And so you need to sit down and say, I'm looking to hold a property for 10 years. And in order for this to be a good deal for me, I need to be generating X% return. I need to be generating X% cash flow. Perhaps maybe you want to quit your job and you need a certain amount of cash flow every month to pay your bills. Or maybe you're looking to build wealth for retirement. And so you need to build a certain amount of profit by the end. You need to sit down before you start analyzing deals and say, this is what I'm looking for in a deal. This is a deal. These are the numbers that I need for this deal to make sense. And then when you go through this exercise, you now have all those numbers. Compare those numbers to whatever you decided you needed for a deal to make sense. And if these numbers are higher than those numbers, it's a deal for you. If these numbers are lower than those numbers, it's not a deal for you. But I can't tell you that 8% is a good deal, or 12% is a good deal. 35% is a good deal, because what's good for me isn't necessarily good for you. I don't need the cash flow to live, so I don't care how much cash flow. But there are a lot of people out there that want to quit their W-2 jobs and they really need a lot of cash flow. So you need to determine what the right numbers are for you, and then run the numbers on the property and say, does this deal meet my needs?
Yeah, great point, Jay. And I think that so many times people listen to different podcasts and read different books, and it's like one size fits all, and it's really not what we speak about. I know what Jay's philosophy is, and certainly not what we speak about in InvestHER as well. It's like, you need to determine where you want to be, those short-term, those long-term goals, and then work backwards. Absolutely. So Jay, thank you so much for opening your brilliant mind and sharing today with our community. I hope everyone definitely reaches out to Jay. Jay and Ashley are doing great things with their work and in buying great apartment buildings. So thank you for all you do and just being an enormous resource in our community. Thank you for joining, everyone. Appreciate you making time to be with us. We have ongoing free events happening. And definitely by March 1, if you have not gotten your ticket for InvestHERCon, check it out. We're going to be doing some great things there in Scottsdale. So without further ado, and then check out future events. You can just go to our website, therealestateinvestor.com/events, and all of our upcoming events are there. So Jay, thank you so much. Appreciate your time so much, and appreciate you, being with us today.
Thanks everybody.
And the webinar recording, and Jay, you said you're going to send me that spreadsheet. Is that cool if you email it to me?
I will email you the spreadsheet and all the slides.
Awesome. And then we'll get that out to everyone within 24 hours. Everyone that registered, you will get an email with the recording and the ancillary docs that Jay shared.
Awesome.
All right. Awesome. Bye, everybody. Have a great day.